In 1973, oil prices quadrupled. The stock market fell 50%. It took 8 years to recover. In 2026, oil prices rose 60% in a matter of weeks. Brent crude touched $138 on a single day in April, within $7 of the all-time record set during the 2008 financial crisis. Gas at the pump hit $4.10 nationally, up 37% almost overnight. The IMF cut global growth forecasts. 6 central banks hiked their rate expectations in a single month, and the S&P 500 hit an all-time high. Same commodity, same kind of shock. Completely opposite market reaction. And if that doesn't make you slightly uncomfortable, you're either already rich enough not to care, or you haven't thought about it long enough. Because the question isn't just why is the market up? The question is, what does it mean that the rules we thought governed markets no longer seem to apply? And today, we're going to find out. Let's start with the explanation everyone reaches for first, because it sounds reasonable and it's wrong. The market is up because investors think this is temporary. The logic goes, the Strait of Hormuz gets reopened, oil falls back to $70, inflation cools, the Fed cuts, stocks rip. It's a thesis built entirely on the assumption that the conflict ends fast and cleanly. And maybe it does, but markets pricing in a quick resolution while simultaneously hitting all-time highs means there's zero margin for error built in. You're paying record prices for a scenario that requires everything to go right. That's not optimism. That's pre-ordering hope on a $7 trillion credit card. But here's the thing. The temporary thesis isn't actually why the market is holding up. There's something structurally different happening underneath the surface. And it has to do with a shift that happened so gradually over the last 15 years that most people never noticed it. The United States is no longer an oil importing country. In 1973, America imported 40% of its oil from OPEC. Every dollar that oil prices rose was a direct transfer of wealth out of the U.S. economy and into the hands of foreign producers. High oil price equaled economic pain. Full stop. That relationship was so reliable, so consistent, so deeply wired into how markets priced risk that it became basically a law of financial physics. Oil up equals stocks down. But the shale revolution quietly repealed that law. Since 2014, the U.S. has been the world's largest oil producer, and not by a little. The U.S. is now producing around 13 million barrels per day. It is a net exporter, which means when oil goes to $115, something very strange happens. The American consumer gets destroyed at the pump, and the American energy sector, which is a very large component of the S&P 500, has the best year of its corporate life. At $100 a barrel, U.S. shale producers generate an estimated $162 billion in free cash flow for the year. At $70 oil, that number is $99 billion. The shock that was supposed to kill the market is simultaneously writing the largest profit checks in the history of the U.S. energy industry. Both of those people are in the index. The market is averaging them. Which brings us to the part that nobody is talking about. American shale companies are choosing not to pump more, even at $115 oil. The old logic said high prices equal more drilling, more supply. Price comes back down. But that playbook has been retired. Publicly traded shale companies have spent the last 5 years getting absolutely lectured by their shareholders about capital discipline. They ran growth at all cost strategies in the 2000s, destroyed their balance sheets, and got punished for it. They learned the lesson. So now, at $115 a barrel, prices that would have caused a drilling frenzy in 2014, the biggest producers are sitting on their hands, collecting the cash flow, paying dividends, buying back stock, and telling investors they're being responsible. Their stock prices are going up anyway. Because the market isn't rewarding production growth right now. It's rewarding restraint, which means the supply response that would normally crush the oil price isn't coming, at least not fast enough to matter. And here's where it gets genuinely strange. The war that caused the oil shock is accidentally helping the AI trade. Stay with me, because this is the mechanism nobody is connecting. U.S. data centers, the ones running the NVIDIA chips powering the AI revolution, run primarily on natural gas. Natural gas generates electricity. Electricity runs the chips. The global price of natural gas exploded when the Strait of Hormuz closed because LNG shipments from the Persian Gulf got disrupted. But U.S. domestic natural gas prices stayed relatively contained. Why? Because American LNG export capacity was already running at maximum before the war started. We can't export more even if we wanted to. The global price went up, The domestic price didn't follow at the same speed, which means American data centers are now operating on cheaper energy than their international competitors. The oil shock that was supposed to hurt the market is, through an accidental chain of events, giving American AI infrastructure a cost advantage over everyone outside the US. And AI is what the market is actually pricing. Tech is leading. Energy is lagging. The Nasdaq has had its longest winning streak in years, right in the middle of a Middle East war. That is not a coincidence. It is a mechanism, which brings us to the part that should make you nervous, because none of this means the market is right. It means the market has convinced itself of a specific story and is currently refusing to entertain the alternatives. And Goldman Sachs, in client notes that most retail investors will never read, is quietly flagging the story the market isn't telling. The market is pricing the inflation risk from high oil. Goldman is warning about the growth shock, and those are not the same thing. Inflation risk means prices go up and the Fed has to respond. Growth shock means the economy slows down, corporate earnings miss, and the stock prices that were priced for expansion suddenly look absurd against contracting reality. The IMF cut global growth forecast to 3.1% for 2026. That's the growth outlook of a world that is slowing down. The S&P is priced for something much closer to the opposite of that. One of those things is wrong. And in every previous cycle, when the IMF and the equity market were this far apart on the growth outlook, one of them eventually moved sharply toward the other. Historically, it's been the equity market. Now let's talk about the detail that almost nobody is covering, because there is a geopolitical development buried under the war coverage that has permanent implications for oil prices, and it happened while everyone was watching the Strait. The UAE left OPEC, effective May 1st, 2026. The country with roughly 9% of the world's proven oil reserves quietly walked out of the 60-year-old cartel that has managed global supply since before most of this channel's audience was born. And OPEC's spare production capacity, the emergency buffer it uses to flood the market and crash prices when it wants to punish someone, just got permanently smaller as a result. In every previous oil shock, there was a ceiling. Eventually, OPEC would open the taps. The market knew it. Traders priced it. The ceiling kept a lid on how bad things could get. That ceiling just got lowered. Permanently. And the market has not fully priced what that means for the oil floor in the next cycle, or the one after that. Here's the uncomfortable truth about what's actually happening. The market isn't stupid. It sees the same oil price you see. It reads the same IMF reports. It knows the Strait of Hormuz is still disrupted and that global growth is slowing. The reason it's still up isn't because investors are ignoring the risks. It's because the structure of the U.S. economy has changed enough that high oil is no longer purely a negative for the market. The AI trade is insulating the tech sector from energy costs in a way that didn't exist in 1973. And the passive investing feedback loop means that as long as the Magnificent Seven are holding, the index holds, regardless of what's happening in the other 493 companies underneath. But here's the thing about feedback loops. They're beautiful right up until they aren't. Because the economic damage from $115 oil doesn't show up in stock prices immediately. It shows up in consumer spending data 6 weeks later, then in corporate revenue guidance 2 quarters later, then in earnings misses the quarter after that. The stock market is a leading indicator when it's working well. It's a lagging indicator for its own mistakes. And right now, the gap between what the market is pricing and what the IMF is projecting for global growth is the widest it's been since right before 2 of the last 3 recessions. That doesn't mean a crash is imminent. It doesn't mean the market is wrong. Markets can remain irrational longer than you can remain solvent, and anyone who tells you they know exactly when gravity shows back up is either lying or selling something. But it does mean that the people celebrating the S&P at all-time highs while oil is at $115 are making a very specific bet. They're betting that the U.S. energy exporter dynamic, the AI insulation, and the shale discipline story are permanent structural changes that fully replace the old rules. And maybe they are. Maybe the 1973 playbook is genuinely obsolete, and we're in a structurally different world where oil shocks don't carry the same weight they used to. Or maybe the market is doing what it always does in the late stages of a cycle, telling itself that this time it's different, finding new reasons why the old rules don't apply, and building a very convincing story right up until the moment the data catches up. So I want to hear where you land. Do you think, A, the structural changes are real? The U.S. as a net energy exporter fundamentally changes the oil market relationship, and the S&P holding up here is a rational repricing of a new reality. Or do you think, B, this is the market in denial, the growth shock is coming, and the S&P at all-time highs while oil is at $115 is going to look like one of the most obvious warning signs in hindsight? Or, C, The option I think is actually most likely and most dangerous. The market is right in the short term and wrong in the medium term. The structural story is real, but the timing is being completely mispriced. And the people who get hurt are the ones who see the rationalization and mistake it for the underlying reality. Drop your take in the comments, because this one I genuinely don't think has a clean answer yet.